Okay everyone, welcome back to the channel. So in this video, I'm going to be going over a case study I took. So ES longs, we're going to be breaking down how I was able to do that using key levels and footprint charts, right? So I get a ton of questions and I'm going to break everything down in terms of my process, how I enter, how I exit, and how you can replicate this on ES, NQ, gold, cryptos, and even the Forex market. So if we just zoom out here, this is the 15-minute time frame, right? I use a 15-minute time frame. So what you can see here is the way that I approach the markets is quite simple in the sense that I'm looking for my basic market structure points, right? So what I can see is we have a structural high, structural low, and then from here we had our structural high, and then we broke the structural low. So what we can see here again, market structure is bullish, right? So we have this structural high up here, and we have this structural low created on Tuesday, the 3rd of March down here, right? So this is our dealing range. So anything in between, this here is our dealing range, right? So this is our dealing range. In fact, what I'm going to do is I'm going to go to a completely naked chart where I'm going to break this down. So when we look at, when we start looking at the markets, we want to understand how our structure actually forms, right? So this is what I do. I kind of zoom out probably 3, 4, 5, 6 weeks, maybe even 2, 3 months. And I mark structure something like this. I go with a structural high. After this low here got broken. So this high was here. This high got formed. Structural low, structural high, structural low. And now from here, every time I see a break, I'm going to draw an arrow. Right? This is the rule that I give every trader, right? So we had a break just over here, right? There's our first break. I know you can't see that. And then we had our second break down here. So now using this same principle, we just continue on the logic. So what we see here again is we eventually see this low getting quite clearly broken over here. So what we're looking for now is we see again structural high, structural low. This was the highest point here, this high before we broke this low. This is an important concept to understand, right? It's not this, it's not any of this, it's not this, it's not this, right? Getting your market structure right will get you your dealing range right, right? So the 4-step process that I use every single time I trade is I start by looking at the basic structure. And that's basically what we've done here. This is the 15-minute time frame on the S&P 500. You can apply this to obviously ES, NQ, and just about any other market that you trade. So the first thing is understanding the market structure, right? What are the highs doing? What are the lows doing? Which high has broken the previous low, or which low has broken the previous high. Now, once you understand this is the highs, and lows. This is our dealing range like this, right? This is the structural dealing range, right? So that's kind of step 2. So after we've done step 1, you want to identify step 2. And step 2, we identify as the dealing range. The dealing range is basically the most recent high and low, right? So the most recent high to low. This is important to understand. It is the most recent high to the most recent low. So this here is the most recent high, and this here is the most recent low, right? So this is the structural high, this is the structural low, right? And what we do over here, step 2 and 3 come together because step 2 gives you step 3. And step 3 is the premium and discount arrays. Premium and discount arrays, okay? Premium and discount arrays. Now, how do we then understand premium and discount? So once we have our structural high and structural low, this is the premium, right? This is the discount. So anything below is a discount, this 50%, anything above is a premium. And it's important to understand this 50% here is basically the halfway point between this low and this high, right? It is the easiest thing to understand, and it's the most important thing to understand. Because what you'll find today, if we just take a look at some of the recent price action over here, the reason we went long from Tuesday and Wednesday is because of this, right? We had broken a previous low, right? We had swept the previous day low, right? And then from here, we're beginning to see higher prices in the discount back up to the premium. Right? This is what we're looking for. So the way that I look at this from a basic structural perspective is like this. Okay, so if I just bring a diagram over here, in fact, let's go back to ES. So this is ES, right? If we go back to our usual time frame, this is the structural high, right? And this is the structural low. So we're projecting the fib like this, but the way you want to understand this is like this. So the market will create highs and lows, right? So we'll see a break, we'll have somewhat of a pullback, we will see a break. And now we're trading in this sort of position here. So the way you want to understand market structure is like this, right? You have a structural high, structural low, structural high, and structural low. And so the question now becomes, you want to be buying below old lows, and you want to be selling above old highs. So this entire concept is about buying below the old lows. So that's what was happening here. So this was an old low, and we're typically looking for longs, or we're looking for higher prices after we've broken a previous low, right? That's basically how market structure works in a nutshell, right? This is the basic format we're following. So once we see a relevant correction here, again, we use order flow to confirm our levels. Once we see a correction, right, this now becomes our structural high, this becomes our structural low. And so this now becomes our premium and discount. So this is premium, this is discount, and we apply that on the charts. So it's about using these basic concepts to your advantage. So if we just take a look now at more recent price action, these were sort of my levels. And so this is the most common question I get. How do I find my levels? I'm not going to go over that in this video, but I'm going to go over key level 1, because key level 1 is the easiest to identify. So if we just go back to Tuesday, right? Tuesday, what we had here is a fair value gap. So I'm just going to break this one down. We had a 15-minute imbalance over here, or 15-minute imbalance. You can call it a fair value gap, you can call it a void, whatever you want to call it. So once we have this void in price, right, we're looking for that candle before price. So this is the candle here, this one here, just here. So this is the fair value gap, this is the key level. And so key levels are only valid when you can understand what was going on inside of them, right? So this is a key level because, not because there's a fair value gap, but because, yes, there's a fair value gap, but more importantly, price acted as supply, price then acted as demand, price continued to act as demand. So what we can see here is supply flipping to demand, again holding as demand. So this is a key level, not because of the fair value gap, but because there is limit orders resting over here. So what makes a key level? Or, as I like to call them, a better word for them is absorption levels, right? Because the market does not have to respect your fair value gap or anyone's fair value gap, right? The market will gravitate towards where there are limit orders. And I'm going to be breaking this down. So limit orders are what creates levels. Limit orders create levels, right? Levels themselves are not created from any of the following: sweeps, fair value gaps, SMT, Elliott waves, right, let me just spell that right. Elliott waves, right? SMC, random lines. I'm talking about support and resistance, right? VWAPs, right? None of these things create key levels, right? The only thing that creates key levels are limit orders. You can use fair value gaps to find voids in price where the market is more likely to react to. Now, just because there's a fair value gap does not mean there's a key level, right? You want to ditch all these and you want to focus on one fair value gap, and you want to see these are sell limit orders here, there are buy limit orders here, there are buy limit orders here, right? So this is key level 1 because the market has shown you that there are limit orders resting in this area. Now, that same logic applies for key level 1, 2, 3, 4, and 5. So all of my levels follow the same exact theory. And this is what I'm going to break down in today's trading session, right? So this was a trade that I took, right? So what we can see here, before we go on to that, let's just go to the pre-market plan. So I've got this over here. So what does the pre-market plan typically look like? So this is what the pre-market plan looks like just before market open. So this is 9:26. So between 9 and 9:30 Eastern, I will analyze the markets, right? I will try and see what was going on. So in this region here, we have key level 1, like I just described, key level 2, 3, and then 4. So typically, if you're in a trading session, you only need 1, maximum 2 levels per day. So the reason I say that is because let's break down the New York session. So when we came into New York session, which was somewhere around here, what can you see, right? So even from my markings, it should become pretty obvious what I'm looking for. So coming into the New York session. Now, whenever you come into New York session, the only 3 things you need to become a successful trader is you need this. You need a key level, you need to have an entry in the key level, and you need to know what's happening in the key level, so order flow. So on the lower time frames, these are the only 3 things you need to be successful, right? So for example, the trade here, let's call this 2, 3, and then 4. Now, you can only execute at one of these levels, and it's your job to know which level to trade from. So you're waiting for a key level. So assuming you have your key levels correct. So this is more like a flow chart. What I mean by that is if your key level is off, 2 will be off, and then 3 will be off, right? So you can be the best order flow reader in the world. If you don't understand where the limit orders are, or if you're not confident in executing with order flow, it's all for nothing. So you need all 3 of them to align. So once you've understood that, let's say you have your 3 levels like this, right? So the plan is quite simple, right? Let's put this to one side. The plan is typically not that complicated, right? What you are looking for in the markets is something repeatable. Repeatable strategies come from understanding that you need to do the same thing every day. So if you want repeatable results, you need to have a repeatable input. And this is the repeatable input right here. So if you find yourself trading and it's inconsistent or it's not repeatable, it's typically because you're missing one or probably all three of these things. So first, what I do is I wait for the first 15 minutes. So I don't trade the first 15 minutes, or I very rarely trade the first 15 minutes. And I call this the 15-minute range. Some people call this the opening range breakout. I don't want to confuse it with that, because the opening range breakout is often, people mess up with that because they don't know either how to read the key levels or they don't have the right order flow system in place. That's why I don't like to call it the orb. I prefer to call it the 15-minute range. Now, once you do that, you want to have an entry into a key level. So let's just dive into 1 and 2 first. So 9:30, the market opens and you're typically waiting for 9:45. So there is the first 15 minutes right there. So this is 9:30. This is 9:45. There you go. This is the first 15 minutes. So what we can see here, typically you can either trade from 2 up to 3 and then maybe up to 4. Or if you want to be safer, you can wait for a break above the 15-minute range and you can trade from 3 up to 4. So a repeatable system simply comes down to your repeatable action. So inputs and outputs, right? It's just inputs and outputs. So if you want repeatable results, you need to have repeatable inputs. And repeatable inputs is coming down to what I put here. So you need to identify your 15-minute range, right? So you're looking for ideally that 15-minute range break, right? You're looking for a 15-minute range break. So this is now the 15-minute high and low, right? So this is the low down here and this is the high. So let's just label those. So this is the 15-minute high and this now is the 15-minute low. These are the two things that matter in the first 15 minutes, the high and the low. The next thing is you need an entry into a key level. So what that means specifically is you're not trying to trade here, right? Or here, or even worse here. You're not trying to trade here. If you get caught up in a consolidation or a chop, it's because your level was incorrect, right? Going back to the basics, key level, entry, order flow. So if you find yourself inconsistent or you're not happy with your results, it's typically down to one of these three things. And you need to fix what the constraint is if you want to move forward. So once you've identified that, once you've got your key levels in place, right, the next thing you're looking for is an order flow based entry. Right, this is the last thing. So you're basically looking for absorption, and I'm going to break down in this video what absorption actually means. So these are your inputs right here. So 15-minute range break, entry into a key level, break and retest, and then absorption, and they all follow each other. And this is how you get repeatable results. So it's always going to be one of these three things that you're missing if you're not repeatable. But let's break down how I was looking at this. So can you see right now your trading is highly systemized because you actually have a plan, right? You're actually trading from level to level. And that's the idea. That's the whole idea, right? So again, if you look at it from a structural perspective, right, we were below or slightly below this 50%. So we're looking to buy, basically. We're buying from discount to premium. That is the idea. Again, if we just take another look at this, we are below that 50%. And so we're just looking to buy from premium to discount, right? So here we go. So this is now in Eastern Standard Time, this is going to be 9:52. So we have our 15-minute range. Now, 15-minute range breakouts are only as good as your levels and how good you can read order flow. Those are the only two things that are going to determine your success when it comes to trading breakouts. Nothing else is going to matter. And so let's start breaking this down. Let's start understanding, right? So I posted this around 10 a.m. Eastern. So we want to understand our first key level down here. So this blue box is the same as the key level. So this first blue box is this region over here. So let's break down the theory of this, right? Let's break down the theory. So we have the first 15 minutes and I'm looking to see a reaction from either this level or this level. Now, typically I never trade the first 5 minutes. So from 9:30 to 9:35, this is what I call this is like the alarm bell, basically. This is like the opening bell. This is not when the market's fully awake. This is like when the market's stretching, right? We can see a big move up and then a big move down. Let the first 5 minutes consolidate, do its thing. But once you understand that, you want to start reading price action inside of these levels. Again, these levels are very important, 2, 3, and then eventually 4. But as you can see in this case, market opens between 2 and 3. So we're only interested in 2 to 3 levels per day. You're only interested in 2 to 3, and then 3 maybe up to 4. So let's kind of break this down. So in real time, you want to understand how the market was reacting. So we can see here, market breaks above our level, or we managed to get above this level, but what was going on? So this is now 9:40 to around 9:45, maybe to about 10 a.m. Eastern. So this sort of rejection over here. So this is again a key level 2, right? Key level 2. What was happening inside of key level 2, right? What can we take away from key level 2? So if we just take a look at key level 2 now, we can see here the same screenshot from the ATAS platform. The prices were 68.20 to 30, 68.20 to 30 on ES futures. So this is now 68.20 to 30. So what we can see is as the market comes into this zone, especially these sort of candles here. So we had this big wick candle down here, this one, 9:45 exactly, right? What's this, right? What is going on here? So when we understand footprint charts in terms of how they actually behave, this is what we see, right? Footprint charts come down to two numbers. You have the bid and you have the ask, right? You have the bid and the ask. Now, what does the bid represent? These are aggressive sellers, right? And what does the ask represent? Well, these are aggressive buyers. So once you understand who is aggressive, the aggressive buyers and the aggressive sellers, you can then start to understand what a footprint chart represents, because a footprint chart tells you who is more aggressive, right? So all this is telling you is who is more aggressive, right? Is it the aggressive? Is it the sellers? Is it the buyers inside of this key level? So notice how we've started with the key level. We waited for the market to enter the key level, and now we're looking at order flow. So this is step 3. So you want to understand what was going on inside of this key level. So what we can see here is a lot of red delta, right? We can see a lot of red delta. And so delta, for those who don't know what that is, red delta just means that there's more aggressive buyers and sellers. So the aggressive sellers, more aggressive sellers than buyers. So there's more aggressive sellers than aggressive buyers. This is the fundamentals to order flow. So once you understand that, there's more aggressive sellers than buyers. What we begin to see here is moves up, right? Moves up here, moves up here. So when you look at this, right, we see red delta, we see more aggressive sellers than aggressive buyers. Now, the next thing to understand is if we break higher, what does this mean? What does this mean to us? So between 9:45 to around, let's call it 10 a.m. Eastern, or just before 10 a.m. Eastern, what do these aggressive sellers tell us, right? Basically, in other words, were they successful? Were these aggressive sellers successful? Where we had multiple breaks above the zone here, we had multiple breaks above the zone here. So were these sellers successful? Were these aggressive sellers successful? Well, the answer is no. They weren't successful. So what does this mean, right? What does this actually mean? So at key level 2, between 9:40 and 10, let's say 9:40 to 10, what was going on? So this is what we mean by, right? This is the order flow blueprint, right? This is how order flow works. So what you're looking for is you're looking for an entry into the zone, right? You're then looking for, if you're looking for longs, right? You're looking for aggressive sellers, and so aggressive sellers are seen via the delta inside of the candles, right? So this is the footprints of each candle. So it has buy orders and sell orders, or in other words, sell orders on the left, buy orders on the right. And so the only thing you need to take away from this is you want to look at the delta inside of the candles to make any decision as to whether a zone is going to hold bearish or hold bullish. And so there are more aggressive sellers, and so the delta is red. And so when we see a break above the zone, what does this mean? Well, it means that buyers are in control. Buyers are in control. And so the reason why buyers are in control is because there is an absorption. And so when there's an absorption, it just means that there are buy limit orders resting there, right? So this is a demand zone by definition, right? Because the sellers failed, which means here, there is an absorption of the sellers, which means that buyers are in control, right? Buyers won the auction there, right? This is basically how order flow works. Now, once you understand that, you can begin to apply the same logic to the next key level. But when you look over here, what you can see here is that the 15-minute low has been respected, or at least intact. So all these sellers over here, the low was not able to be broken. This you can call maybe a protected low, or this is an area of demand This is a demand area, right? Buyers are in control. Buyers in control. Buyers in control. Now, when we come to key level 3, so this is the trade that I took. So executions for this day were something like this. So my execution for this day came just at 68.59, right? 68.59 based on the order flow. We're gonna discuss this in a lot of detail. So what we can see here is price coming above the zone like this, right? So we actually broke above the zone. So my execution for that day, or Wednesday, was at 68.59. So 68.59, I decided to go long, right? 68.59. So just like this, I was comfortable to have my stop below this wick, and I'm going to explain why. And I was looking to target basically the previous day high. So for me, the previous day high was over here, right? There you go. Now, I wasn't comfortable to hold this trade past the previous day high because we were at a key level. So this is now key level 4. Right, this is also another key level, right? Because there were limit orders resting here. So when you know where the limit orders are, not only do you know where to enter, you know where to exit. So this trade was basically from 2 to 3 to 4. And so if you're inconsistent as a trader, it just means that your levels are off or you're not executing the right way. So this was the scalp, right? Or this was the trade. About 13 minutes into the trade, just under a 2R risk reward. But before we kind of talk about the exit, let's actually talk about the execution. Right, so there was only one reason I was confident to execute or stay in this trade. It was because of two specific candles, this one and this one, right? So we want to break down exactly what was going on over here. And this is how we do it, right? This is a summary of the trade. So we had a 15-minute range break. We had rejection of key level, break and retest. We went all the way long to the next level. So the easiest way to trade is to define your levels, wait for market to hit those levels, and then read the order flow. And so the order flow looks something like this. So we want to break down these two wicks specifically, starting with this one, right? So let's just understand how a footprint chart works. This is how a footprint chart works, everyone. So what does this mean over here? This is 248 for 92, right? So this wick, or this long wick over here, is this wick here, right? Look at that. This is a zoomed in version. So for those who are wondering, I execute directly on the ATAS platform, the order flow platform that I use. And the way this wick formed was, yes, we had a break to the upside. So that's this candle here and this candle here. This is my execution candle, but this was the confirmation. So we have the key level, we have the 15-minute high over here, or just about the 15-minute high range break where I executed. But the most important thing is confirmation via the order flow at the key levels, right? I'm going to say that again. Execution, confirmation happens inside the key levels through the order flow. So in other words, this is your execution right here. This is your confirmation. This is your confirmation. So what did this wick actually have? Well, this wick had lots of aggressive sellers, and we had a break higher. So when you have lots of aggressive sellers and a break higher, what this means is that buyers absorbed sellers. That's it. That's all that happened here and also here. And we see the same thing here as well, right here, same thing. So this candle here, so here and here, this confirmed inside of the key level, right, that sellers were being absorbed, which means that buyers were in control. Buyers won the auction, right? Buyers were really in control of the market here. And so if we just play this out, right, we eventually go on to hit the target and we break above. So this was the trade recap, right? This was the entire trade. So that's basically in a nutshell how I trade. It's about 847 on the day, risking about 500, so just under 1.8 or 1.7 R risk reward. 1.7 R. So this is the execution that you're using, and these are the sort of the levels. This is sort of how you want to read the levels. And so if you're looking to trade order flow, right, if you're looking to add order flow, right, because I get questions about this as well. If you're looking to add order flow, you want to get good at identifying your levels before you move to the footprint charts.